melts all my fears. In your embrace, I forget the years. Every moment feels so brand new. 'Cause with every step, it's you. Your love's my light through stormy skies. Your eyes, my shelter where safety lies. With every step I fall for you, the warmth of your touch.
Hello everyone, can you hear me?
Yes, very clearly.
Okay, thank you also. So just wait, I think we can wait for our host. By the way, I'm ready to go, guys.
The warmth of your touch, it's all I need.
Yep. Hi. So I think I just came in just on time. So hello everyone and welcome to a very special edition of the Talking Web3 Global AMA series. So tonight or today we are going deep into one of the hottest and most important questions in the post-launch world of Binance Alpha tokens. So can community liquidity replace market makers? So newly listed tokens in the Binance Alpha ecosystem often attract significant early interest, but many experience significant price corrections shortly after launch. For example, tokens like ZKJ and BR initially stabilized before experiencing significant price drop due to limited market depth and insufficient sustained liquidity support. So Polyhydro Network's token ZKJ plummeted over 80% to 90% in 24 hours, from approximately $2 to 30 cents, driven by a massive liquidity withdrawal from the ZKJ/KOGE trading pair and a planned token unlock. These actions triggered a cascading liquidation event, wiping out nearly $500 million in market capitalization. So another token, BR, Bedrock token, experienced a flash crash of approximately 50% in less than 10 minutes, falling from 0.129 USD to 0.053 after multiple large addresses withdrew over 47 million USD in liquidity almost simultaneously, resulting in insufficient liquidity in the underlying fund pool and a significant price drop. So these events highlight how insufficient liquidity and an opaque centralized liquidity provider model expose tokens to high volatility and manipulation risks, undermining trust in Binance Alpha mechanism. So this raises a key question. Can community-driven liquidity provision become a sustainable alternative to traditional market makers? So emerging DeFi protocols are moving away from relying on centralized market makers and instead experimenting with DAO-based liquidity mining, staking incentives, and staking mechanisms. These models aim to align project success with user engagement, transforming passive holders into active liquidity contributors. This AMA will bring together developers, liquidity experts, and researchers to explore the potential of this paradigm shift and whether it can bring lasting depth, stability, and trust to the alpha market. So joining us today, joining us for this powerful discussion are several amazing guests for today. So first up, let's welcome Austin, who is the community ambassador for Alpha World. So hi Austin, do you mind introducing yourself and Alpha World?
Oh yes, I'm the first one. Thank you for giving me this floor. Actually, the first. Definitely. So as you mentioned that, I'm the brand ambassador of their Alpha World. So let me share a bit about what is Alpha World actually. So the Alpha World is an institutional-grade alpha revenue aggregation platform that included by BWC Labs that built on the power high potential projects within the Binance Alpha ecosystem. So unlike the traditional launch, the platform or general incubators, that Alpha World focuses on the post-listing acceleration, that delivering structured liquidity support, capacity synergy, and sustainable community growth to the projects that are already listed but I can say underexploited actually. So we have our main vision that is to become the world leading alpha asset empowerment platform that driving deep liquidity, strategic coordination, and the real user consciousness across the Binance Alpha landscape actually. So we're trying to bridging the capital and community through the structured DeFi model and building a sustainable user income network and creating a transparent and the trustless ecosystem for the collaborative value and generation actually. So we have our first project which is the AIoT. It's proof like it works over the 10 million AIoT staked in the main contract pool and holder that count growing from I can say 198k to over 260k in just within a few weeks actually, a few weeks up. So and the price is staying resilient in the like 0.3 to like 0.42 range even during the market the pullback actually. So if you visit our website, I think which is alphaworld.com, I think you'll be able to find the very details. So this is a bit about myself and also the Alpha World. Yeah, thank you.
Thank you very much, Austin. So with that, let's head on to the BD lead at Dex1, Emron. Hi, Emron. Is that how I pronounce your name?
Yeah, actually, my name is Mr. One. It's okay, never mind.
I'm so sorry. Hi, Mr. One.
Okay, hi everyone. I'm Mr. One. I'm from BD Lead from Dex1. Dex1, we are the first AI intent-driven on-chain trading platform. From our platform, that we have some sexy AI features like smart AI signal that we can scan the on-chain data, never miss the price explosion and real movement. And we also have the 24 hours, 7-day AI monitoring that we can follow all the smart market, smart money, smart wallet. Then we can come out some summary for you to follow to set your AI strategy trading engine. So we are support multi-chain. We currently support 4 different chain. The one more thing that our application that we can work is very special, that we don't need to have any button clicking, because we are a AI intern platform that you something like you talking to a chatbot, then the application will execute for you. All right, thank you everyone.
Thank you very much, Mr. One. So next, can we have the Regional BD Director at ACM Plus, Hassan, to introduce himself and the project. Hi, Hassan.
Hi everyone. First of all, thank you for hosting us, Talking Web3 Global and Potato. Am I pronouncing your name correctly?
Yes.
Okay, perfect. As she just mentioned, I'm the Regional BD Director for ACM. AI ACM or AI Cross Matrix has recently closed its $12 million US seed round actually. So that's a milestone that I can share first with everyone here. And when it comes to what we do here is that it's a next generation privacy-focused protocol for cross-chain value transfer and yield generation. So rather than relying on a single privacy mechanism or limiting users to one network, ACM integrates zero-knowledge proofs, AI-generated ring signatures, and AI path obfuscation, basically to provide multi-layered protection for both identities and transaction details. At the same time, as I said, yield generation. So ACM's fee structure basically rewards liquidity providers, enabling them to earn yield while supporting the network's privacy infrastructure. I know it's so many, all these words. It may not be always really easy to understand for some of our listeners. So I'm gonna just use an example to better explain what ACM can do for you. All right, so you can now imagine you're sending one Bitcoin. Instead of one big chunk moving straight across a bridge, which is obviously easy to spot, right? What ACM does is its AI technology breaks it into millions of satoshis, sprinkles time delays, and finds the cheapest, least congested gas lanes. So every time someone makes a cross-chain transfer, also a slice of the tiny network fee is paid out to people who parked liquidity in ACM. So in conclusion, while you enjoy private, faster and cheaper transfers compared to many other solutions out there, as well as traditional bridges, also if you provide liquidity, you can also earn steady yields. Yeah, that's about me and ACM. Thank you.
Thank you very much, Hassan, for the introduction. So, last but not least, we have a special KOL guest who is building Labs Web3 and is a professional in strategic planning, BD, and has plenty of other talents. Let's have Mini BB. Hi, Mini BB.
Hello, Potato, GM. Good morning, everyone. Minnie here, and thank you so much for inviting me as a guest speaker for today's AMA session. Just a little bit about myself before we dive in. I'm Minnie, working full time in Web3 as a BD, content creator, and also a trilingual spaces host. Absolutely very happy to be here today. Thank you so much. Thank you, Potato.
Thank you very much, BD, for joining us today. So, with that, let's jump into the core topic, shall we? So, let's start with definitions. How decentralized market makers operate and what makes DAO-based or a token-based models structural differently. So, the question here is, what are the fundamental differences between traditional market makers and community-based liquidity providers? So first, can we have Austin?
Yes, definitely. Thank you once again. So yeah, very good question. I think if I talk about the today's market situation, so the key difference between the market makers and community liquidity providers that lies in their like I can say several reasons like their motivation, the funding sources, and impact on the market sustainability. So the traditional market makers that rely on external capital and operate with the primary goal of making a profit. So they are often professional trading firms that provide the liquidity temporarily and may like withdraw it without notice. So which can lead to uh, sudden price collapses, like as is seen in the case of JKJ and also BR, like in the mid of 2023, the tokens that the both of the tokens that experienced a rapid price crashes after their traditional market makers abruptly withdraw the liquidity actually. So these market makers had no longer alignment with the project. They were simply providing the liquidity in exchange for the fees or incentives once their agreements ended or market conditions changed. They exited, and also because most of the liquidity was constructed on their like in their control, and the token, the price, the plugged within the minutes. And also there are a lot of examples. You can just do your own research from the market, I think so. So I can say like in the contrast that community liquidity providers are typically existing token holders who contribute their asset to the liquidity pools to support the tokens that long-term success, and their liquidity is provided on chain, ensuring the full of transparency and alignment with the project goals. So governed by the decentralized autonomous organization, which is the DAO, or you can say the DAO, that community provided the liquidity that follows predefined rules rather than the being managed behind the closed doors actually. So this creates a more stable and transparent and mission-aligned market structure where uh, like those who provide the liquidity are the same individual who benefit from a healthy and thriving the token ecosystem. So I can say these are the situation actually, like in short terms I can say that is traditional market makers can create the artificial depth that disappears overnight, while the community liquidity pools build a foundation that more aligned, decentralized, and long-term focus. Yeah, thank you.
Thank you very much, Austin, for the elaborate, in-depth opinion. So with that, let's head on to Mr. One. Bello, Mr. One. So this is the time where I will usually say knock knock, and he will reply who's there, but he's not there. So anyways, I'll call you back later. So let's head on to Hassan.
Hi again. Yes. Well, um, could you please repeat the question?
So what are the fundamental differences between traditional market makers and community-based liquidity providers?
Right. So, I think we know that traditional makers are a few professional desks. What they do is renting depth, whereas community liquidity puts that depth in thousands of wallets, on chain and also incentive aligned, as the previous speaker had mentioned, they have motivation to do so, right? The community has that motivation. Also, when a market maker exits, books can go thin really fast. We know that there are so many examples of that. But when community LPs stay, debt is stickier and transparent. Um, So, as we said, they are professional desks, right? Whereas community liquidity providers are thousands of token holders. When it comes to incentive aspect, uh, what market makers do is just earning by capturing spread, or they are paid retainers. On the other hand, community liquidity provision by pool fees and also token rewards. Um, and also one thing that is really important is the transparency, the visibility, right? Usually, market makers are off-chain, opaque, um, but community liquidity providers are on-chain and fully auditable. For instance, in ACM's own model, every deposit, withdrawal, and even the buyback and burn of ACM tokens happens in a visible contract. And also 10% of every sell is burned, and half of every withdrawal fee buys back ACM before burning. So that's also some example I can give. And also when it comes to, I think also there's stability aspect. We know that this kind of rented debt can vanish in minutes, uh, but a community LP, that kind of debt is sticky because it's fragmented, right? And also they have motivation. Um, it's really the community liquidity provision, I think, in my opinion, is very, very important, because it kind of serves as a resistance against shocks. Like this brings this event to mind when the USDC pack snapped in March 23. Curve's triple still cleared about $6 billion in swaps, and LPs earned about 5 million in fees because well, no single party could drain the pool. And it's also kind of long run debt, community liquidity. Even in the 22 bear market, overall liquidity on Uniswap fell far less than crypto market cap. So that shows us something that crowd-funded pools hold up better than, I think, dealer books. That's my take on this. Thanks, Potato. Back to you.
Thank you very much, Hassan. With that, can we head on to Mini?
Hello, Potato. Thank you so much for the question. I think definitely there are some fundamental differences between the traditional market makers and community-based liquidity providers. But let's start with the basics. When we talk about traditional market makers, we're actually talking about professional firms, which large amount of capital. Like they have advanced trading algorithms and also years of experience in managing markets. And their job is to make sure there are always buy price and sell price available so that traders can enter and exit position without causing big price swing. They can also do this pretty fast and also very efficiently. But here's the problem, their loyalty is purely financial. Why would I say this? Because if they stop making money, they can withdraw their liquidity immediately. And when that happens in a small or newly launched market, the price can collapse in seconds. So that's how serious it is. But community-based liquidity providers works very differently because instead of one or two players controlling the market, you have many individuals token holders or sometimes the entire DAOs contributing their assets into the on-chain liquidity pools. Everything is transparent because it's on-chain. And also the motivation is not just short-term profit. It's also about supporting a project where they believe in. So the upside of this model is that it's more decentralized, more aligned with the community long-term interest, I would say. So it doesn't depend on a single player. But there are also some challenges which you have to make sure there are enough people to keep their liquidity in the pool, even when the market becomes volatile. So basically, you can see that community liquidity is more transparent and aligned with the project, but it needs strong commitment from the participants to keep the market healthy. That's my take. Thank you so much.
Thank you very much, BB. Thank you very much, Mini. You can be my BB. It's okay. So, um, I would just like to point out, yes, Mr. One, it's your turn, but you need to reply me. So when I say
Yeah,
knock,
I'm back.
yeah,
Because just
so
now I have some internet connection error. That's why I cannot talk just now.
you have to reply my joke. So knock knock, knock
I'm
knock.
back.
I see.
All right. Okay.
Yeah.
I share my opinion. I support what Mini BB is sharing because they are different in bringing different results. Because the traditional market maker are central and profit driven, while liquidity provider are decentralized and incentive driven. Liquidity are coming from different people and different goals, so it make different market movement. Community based liquidity provider are not from ability get more liquidity to the market because if from the community base we work every back to the mindset from institutional fund and the community fund. So currently we Text One also doing the AI intern trading to enhance community liquidity by intelligently the routine trade, optimizing the yield strategy and detecting some smart money movement to maximize the LP return. Thank you. This is my sharing.
Thank you very much, Mr. One. So with that, let's head on to the next question. What are the realistic strengths and limits of these models? Can they actually handle volatility? Can they support new listings long term? So, to what extent can community liquidity models, like for example staking, bonding, or V tokenomics, act as sustainable and decentralized substitutes for market makers? So, with that, can we have Austin?
Yes, thank you. Thank you for passing it to me once again. So yes, like I think it can, like community liquidity can, that in many cases, if I say, they replace the traditional market makers, especially within the decentralized finance ecosystem, like um, on decentralized exchanges like the Uniswap or Balancer, liquidity is primarily provided by the community through the liquidity pools. So this model that works well when the project has a strong, engaged user base that delivers in the long-term vision and um, I can say like incentivized through the trading fees or governance rewards. So, community liquidity is also transparent as it exists on chain and like is governed by the DAO, which means the decision through like around the liquidity incentives and reward are made by collectively and openly, like nothing to hide there actually. So, this fosters the trust, aligns incentives, and avoids the risk associated with the centralized agreements. So, however, the traditional market makers is still like they play an important role in this like specific context. So the centralized exchanges that require the deep liquidity and the tight spreads to offer a smooth trading experience which the retail community providers may not be able to ensure at scale. So, for the newly launched or low value tokens, the professional market makers can help stabilize the prices and attract early volume. And additionally, in environments that demand high frequency trading or cross chain arbitrage, that institutional market makers with the sophisticated infrastructure that remain very, very valuable. So, while the community liquidity can offer a sustainable and a decentralized alternative, especially in DeFi, but the traditional market makers still serve the important function in centralized or high demand trading environments, I think so. So, that's the answer of your question. Thank you.
Thank you very much, Austin. So with that, can we head on to Mini?
Sure. Thank you so much, Potato, for the question. Personally, I believe community driven liquidity can replace traditional market makers in some situation, but it requires the right structure. There are three important things that must happen for this model in order to work for the long term. So, firstly, I think the incentive must match the goal. Which is if a project wants deep liquidity for months, it can't just reward people for providing liquidity for a few hours. It needs mechanism like lockups, we tokenomics, or bonding, where the highest rewards go to those who commit their liquidity for the longest period of time. So, secondly, we have to acknowledge that providing liquidity carries certain risks. Why would I say that? Because liquidity providers might face a impermanent loss like sudden volatility and also unpredictable price swing. And if we want community members to take this role, they need to be fairly compensated. And that can include things such as sharing protocol fees, or maybe giving them the governance right, or even offering insurance for some extreme cases. Thirdly, I think the incentive has to be flexible because the market condition changes pretty fast, and a program that works well during the calm period might fail completely during the high volatility period. So you guys do know that, right? So that's why the reward structure needs to adjust dynamically. So the liquidity providers are motivated to stay in and also keep the market healthy exactly when it's needed the most. So, do you think this model will completely replace the professional market makers everywhere? I think probably not in every market, in my opinion, but it can absolutely provide a more transparent and community aligned alternative. That's my sharing. Thank you.
Thank you very much, Mini. So with that, can we head on to Mr. Wan?
Yeah, thank you for the question. So I agree all the guests are sharing. Here have some additional sharing is like about the demand side utility. All the tokens should have real use case like governance, fee discounts beyond the speculation. And then another point is AI augmented efficiency. Next one have a signal system track a smart money flow, helping LP capitalize on high yield opportunity while minimize impermanent loss. However, professional market makes still play a role in extreme volatility or low liquidity scenario. A hybrid model like community LP plus algorithmic support may be optimized. Thank you.
Thank you very much, Mr. Wan. And last but not least, can we have Hassan?
Yeah, interesting question. It's I think it can to an extent. I think for day-to-day trading, they can community liquidity can shoulder most often 70 to 90% of the required debt, and it can do it so even more transparently and at a much lower cost than some, retained market making desk. Um, but in extreme and fast moving shocks, you still want an extra kind of backstop, either protocol owned reserves or a time boxed RFQ line to a pro desk. But those are supplements, not the primary source of liquidity. And why I think it can shoulder most of it most often is that because there are certain aspects, as I mentioned in the previous answer, also I've touched upon this the stickiness of the community liquidity. I can also give some examples for each aspect so it can be understood better. In terms of stickiness, we know there are like on Curve Finance platform, um, their VCRV token you needs to be locked for 4 years, and in return it can be boosted up to 2.5x. So that makes people community to lock their VCRV tokens, right? And also, their community liquidity is usually self-financing incentives. Rewards are usually paid from swap fees, not some treasury burn. Like we know, VBAL lockers, they can receive about 75% of protocol fees. So that's a very good motivation there, right? And also in ACM's case, what we do is we have set aside 80% of total ACM token for mining rewards. So that isn't something we rent, it's kind of baked into the token supply. And when it also, as I mentioned before in the previous answer, the shock resistance, that kind of role that it plays, it's really important. And you should remember the USDC DPEG example I've given you in the previous answer. Also, there's a kind of alignment with the community liquidity. Basically, lockers gain gauge wadding power, which steers emissions toward pools that need depth. That's also some important aspect, in my opinion. And the cost, of course, cost is also very important, right? Basically, emissions are denominated in protocol tokens or fees with community LP. So there is no such, six-figure cash retainer to some market maker desk. So it also makes it cheaper, right? But there's also a limit. I think it's very important, especially in a market like crypto. It is the speed of the reaction. basically locked LP capital cannot spin, on a dime. Therefore, a protocol-owned liquidity shield or pre-committed RFQ desk can plug the first block gap. So that's one limit there that's on top of my mind. And what we do at ACM also is that our baseline depth comes from community staking, but we pair it with an AI managed liquidity shield that already deploys protocol owned liquidity. And when that happens when volatility crosses preset thresholds. And that basically lets us avoid perpetual market maker retainers. And at the same time, we're guarding the tail events where raw speed matters. Yeah, that's my take on this one. Thanks, Potato. Back to you.
Thank you very much, Hassan. With that, let's head on to the next question, shall we? So, how do you actually incentivize sticky liquidity? So, what roles do lockups, dynamic rewards, and gamified mechanic play? So, what are the most efficient ways to design tokenomics that attracts stable and long-term liquidity contributions from the community? So, with that, again, let's have Austin.
Yes, definitely. It's a very good question. I think like designing a good tokenomics is very effective for any kind of project, like so that people can get an idea that what you're building actually. So that I can say it depends on different kind of like aspects that designing the tokenomics that attract the stable long-term liquidity is one of the most critical elements for the sustainability of any crypto project. So based on the both industry practices and that observe the outcomes across the DeFi protocols, that effective tokenomics must be designed to align the long-term incentives that minimize the volatility but build the trust with liquidity providers. So I can share some factors that first of all, incentive alignment, which is very essential, like tokenomics should reward the liquidity pool not just for the providing liquidity but for maintaining it over the time. And like this is the best achieved through the like the tiered rewards, and where the longer communications or the longer community I can say the community people that receive um, properly the higher yield. So a strategy that is used by protocols like the Curve or the Pandel, and additionally that vesting schedules for liquidity mining rewards can reduce immediate the sell pressure, and which held the present see the capital from the I can say the stabilization of the token price. And another proven approach, which is the fee sharing mechanisms, where the liquidity pool earn a portion of the platform's and transaction fees in stable coins or the blue chip assets. So this creates a real yield model, which is far more attractive than the sustainable token emission actually. And another I can say the loyalty actually. Loyalty for that protocol can implement the bonding mechanisms as seen with the Olympus DAO, where users provide assets like stable coins or liquidity pool tokens that in exchange for discounted project tokens actually that is locked and passed over the time. So this converts the temporary liquidity into the long-term protocol that owns liquidity pool, which gives the project more control and resilience during the market swings. And the government's right that tied to the liquidity pools tokens also incentivize the long-term participation by allowing liquidity pool to the vote on treasury management and reward structure or development direction. So the project like the creates a shared sense of ownership when liquidity providers feel they have a voice. They're more likely to support the ecosystem long term. And importantly, one of them is the reward emission that must be sustainable that many failed projects, I can say, that offer the high short-term APIs that attract the first liquidity, but the collapse under the pressure actually of the massive token dumps. So a carefully modeled emission curve that ideally decline over the time or based on the performance metrics that is very critical. So transparency is one of them, which plays a big role. The clear communication, open source contracts, DAO, and also on-chain tracking dashboard. So that is like help the build more trust, and liquidity are more likely to the commit when they can verify where the funds are going actually. So like how the decisions are made and also how the reward are calculated. So attracting the long-term liquidity that isn't just about high APIs, it's about designing an ecosystem where the loyalty is reward, risk are managed, and incentives are aligned within the long-term vision. So that's the key facts that you have to mind when you are designing a good tokenomics. Thank you.
Thank you very much, Austin. So with that, can we head on to Minnie?
Sure. Thank you, Potato. For this question, I think for me, if I were designing tokenomics to keep the liquidity stable for the long run, I would focus on rewarding people for how long they can commit, but not just how much they can put in. So think about it. If someone locks their liquidity for 6 months or even a year, so they should be getting way more rewards than someone who is only there for a week, right? So that's where we tokenomics really works well because it gives better rewards and more governance power to the people who are on it for the long run. I would also make sure that's revenue sharing. If the protocol is making money, either from the fees or any other income, I think a portion of that should go straight back to the liquidity providers. So with that way, they are not just farming or and also dumping the rewards token, they are actually sharing in the success of the project. And of course, on top of that, I would also add the progressive rewards. So basically, the longer you keep your liquidity in the pool, the more use it grows. So it actually makes you feel leaving early is less attractive and staying in can be more rewarding. Oh yeah, and one more thing. I would also be keeping a close eye on the token emission. So that's what Austin has mentioned. Just some brief explanation from me. For example, if you release too many rewards in a short time of period, people will just sell them and walk away. But instead, I would spread them out maybe with vesting or maybe with auto compounding so that the reward can keep people engaged over the time. Yeah, that's my opinion. Thank you so much.
Thank you very much, Minnie. So with that, can we head on to Hassan? Oh my God, is it?
Yes,
Yeah,
I'm here.
yeah.
Sorry for the late reply. I am here. Well, I'm gonna. Well, the previous speakers have mentioned really good points. Um, um, I'm gonna also mention some, including some of those they mentioned by also referring to my previous answers. Um, well, I think first is that there should be some kind of time-weighted boosts, and that brings the previous example I gave, this on Curve Finance platform, right? You need to lock VCRV for 4 years, or there is this V-ball which you need to lock for 1 year, so that you can multiply your rewards up to 2.5x, and basically you're turning LPs into long-term partners this way. That's one thing, and then another one is that it should be kind of real yield, right? And again, it's There's the balancer platform basically routes 75% of the protocol revenue straight to VBAL lockers. So there is no treasury drain. And also there can be dual asset payouts. And that happens with a GMX token. 70% of fees plus the escrow GMX vest to GLP providers, and the rest it goes to stakers. And something else, I think it's also I have also mentioned this, the governance voice. Basically, couch systems like on Curve, Balancer, and also Pendle, they let lockers steer emissions toward pools that lack depth. So that's kind of self-healing liquidity, which obviously is very crucial. And also, again, the protocol-owned liquidity is crucial here. Kind of, Olympus style bonding, which actually lets say DAO own a base layer of LP tokens, so there is always kind of a minimum bid, even if farmers rotate and go somewhere else. Yeah, I think these are several things that needs to be definitely taken into consideration. Back to you. Thanks, Potato.
Thank you very much, Hassan. And last but not least, can we have Mr. Wan?
I thank you, Potato. Okay, for the question, we observe key strategies in some successful project. First thing is about the token model, like what the other guests mentioned. So I skip it because this one is about the locking token for the period and get higher reward and governance power. Second thing, what I we observe is the dynamic emission to adjust reward based on demand. Our platform Dexron, we have a AI sniper bot prioritize the high volume pool, and we do need fee redistribution to share the protocol fee with the liquidity provider and staker, like what Uniswap V3 here doing. And I think the gamification and NFT also a key element. It can reward long-term LP with NFT or tier benefit. The last key I want to share is AI optimized incentive like Dexron intent driven engine that we auto adjust the strategies based on market condition to maximize LP return of investment. This is my opinion that the key strategies that we observe. Thank you.
Thank you very much, Mr. Wan. So with that, let's head on to the fourth question of today. So, do you guys mind sharing successful examples where decentralized liquidity provisioning led to better price depth, resilience, or user engagement? So, are there projects you've seen where removing market makers actually improved the ecosystem, or maybe even created stronger holders? So, with that, back to Austin. Austin.
Oh, sorry, can you hear me?
Yeah, we can hear you now.
Okay, yeah. So that, yeah, like there are a lot of examples. Like if I talk about the Uniswap, which is UNI, and GMX token, but I can share this example with our, which is our the first project AIoT. So like I can say that is like our AIoT is the strong case in point actually. Like unlike the many projects that rely on external market makers to manage their liquidity and order the books, and like our project, our that is AIoT, choose a decentralized path but launching with community staking pools without paying large fees to the centralized MMS. So the project that empowers its token holders to provide liquidity directly within just a few weeks over the 10 million the tokens that were staked already. So creating a deep and on-chain liquidity base. So this community-led approach ensured that even during broader market dips, the order books that remained resilient, avoiding the kind of sudden and violent prices that crashes often seen when the traditional MMMs pulled out. So, what made this model even more effective that was the dual incentives structure, which is the participants benefited from the both price appreciation of the token and ongoing pool rewards that keeping the community engaged and aligned. As a result, the liquidity providers that weren't just passive speculators, they had skin to the game, and a reason to protect and sustain the tokens market held. So this aligns with the broader trend in DeFi, where the ownership of liquidity equals the production, traditional MMM playbook for the both resilience and the engagement. So that's all. But by the way, guys, you can do your own research from the Google or our site if you want to know more the details. Like as I mentioned, there are a lot of these examples out there. Thank you.
Thank you very much, Austin. With that, can we head on to Minnie?
Yeah, sure. Thank you, Potato. I think some of the there are some really good examples of the decentralized liquidity model that have actually worked in the real world. One of it, which is the Curve Finance. Not sure if you guys know about this, because Curve uses something called the VECRV model, which basically means the longer you lock your tokens, the more voting power and rewards you will get. And the people there aren't just there to earn the quick rewards. They literally invested in the long term in a long term project. And another one thing I really like is the balancer liquidity bootstrapping pools. So here's how it works. The pool starts with a high token price and then gradually lowers it over time. So that gives the community a fair chance to buy in at different stage. And it also stop big investors from dominating early and also make the price discovery much more stable. And also there's a top mac, which is pretty interesting. That makes it that takes a different approach because they have this thing called the reactors. And token holders vote on which pools get the liquidity. That means the community, not just one central market maker, decides where the capital goes. Sounds fun, right? And actually, all these three models I've mentioned share the same core traits, which are transparent, and also they are also giving out strong rewards for staying in, and also they have the strong community control over the where the liquidity goes. If you get those things right, you will have deeper and stronger markets even in the volatile times. Thank you.
Thank you very much, Minnie. So with that, can we head on to Mr. One?
Yeah, okay. Thank you for all the guest sharing. For the successful example like Uniswap, Curve, and Hyperliquid that everyone share about, I don't need to talk more about that. But I hope that we next one will be the next successful example because we are doing some AI enhancement because of we have the features like our resonance signal detecting trending pool, directing the community liquidity where is most needed for optimal debate and resilient. This is what I share. Thank you.
Thank you very much, Mr. One. So with that, last but not least, can we have Hassan?
Yes, so there are already some really successful examples out there, which some of which were already mentioned by the previous speakers, and I'm gonna add one more to that shortly. Is Pendle platform. Basically, over half the float locked in vPendle, and that drove double-digit APYs on yield markets. And that happened during this year. And I think I have also mentioned Curve protocol before. Curve Finance, basically, three pool on Curve Finance. They processed 6 billion volume um, uh, in March 2023. And that was during that USDC scarcity. But still, pool stayed tradable despite the chaos. So that what it tells us is that thousands of LP wallets meant no single desk could rock liquidity, because we know that basically traditional market makers are their debt, their money's mercenary. So once they don't have the motivation, they don't make money, they will just leave, and that can lead to really harsh conditions, as we all know. Yeah, that's my take on this. Back to you.
Thank you very much, Hassan. With that, let's head on to the last question of today. So, looking ahead, what hybrid models could balance community participation with professional level market depth? So, once again, back to Austin.
Okay, thank you, Potato. So let me answer this one. I think like the future of liquidity is likely hybrid, combining the strengths of both community liquidity and the professional market makers to build robust, transparent, and resilient markets. So, community liquidity that sourced from staking pools and governed by DAO that should from the core foundation. So, it ensures that the long-term alignment, digitalization, and ownership. These participants are typical loyal holders who contribute the liquidity not just for short-term gain, but also to support the project vision and also earn that ongoing rewards. So this creates sticky liquidity and that doesn't vanish during the market stress. However, there's still a place for professional market makers, especially during the high volume periods, the token launches or major exchanges listings where the large orders require like the tighter spreads and the deeper order books in the hybrid model. The pros can be the both like in terms of the transparent, the time bound contracts, not closed door deals actually. So with the clear incentives and defined responsibilities, this avoids the pitfalls of the dependency and also sudden liquidity exits. So to balance the both forces, that reward structures should be designed so the community liquidity pools and the pro market makers the both benefits. For example, through the shared trading fees and also emissions or access to the governance perks with the DAO oversight. This hybrid system that becomes sustainable and accountable ultimately. So this model delivers a stable mission that aligns liquidity from the community plus scalable market depth from the professional when needed truly the best and the both worlds. Thank you.
Thank you very much, Austin. With that, can we head on to Mini?
Thank you, Potato, for the question. For this question, I don't think we have to choose between a community provided liquidity and professional market makers. So, in fact, I think in many cases, the best approach is a hybrid model. For example, when a token first launch, you can bring in professional market makers to set a baseline of liquidity and help to keep the price stable. At the same time, you can launch a community liquidity program, maybe through staking rewards or maybe like through retokenomics or bonding, so that over time, more and more of the liquidity comes from the community itself. Another option is a protocol owned liquidity, where the project own the treasury holds liquidity pool position permanently. Because with that way, there is always a certain amount of the liquidity in the market that can't just disappear overnight. So you see this. And another option is you can also run core incentive programs. This is where both professional market makers and the community liquidity providers get the reward from the same pool. It can turn them into partners instead of the competitors. So in the end, I think it's not really about picking one side over the other. It's all about finding the right balance. That's my take. Thank you so much.
Thank you very much, Mini. Last but not least, because I see Mr. One is not here. So, last but not least, can we have Hassan?
All right. I think there are already examples that can even do that already has this kind of hybrid approaches in the market, and there are also projects that are at testnet stage, and one of those is I think is basically protocols, like one of them will be DYDX v4. What they do is they put fees in an on-chain megavault, which is, this is one of them, is in a public testnet stage, and that megavault behaves like an always-on market maker and insurance fund. Basically, when volatility spikes, it steps in automatically. And also, there should be like a platform on liquidity and gauge voting. If this can be combined, that will be good in terms of like it will let a DAO own a base layer of LP tokens, while others redirect fresh emissions to basically any pool whose spread widens. And this keeps markets kind of self-healing. And also, liquidity marketplaces like TalkMac, they let projects rent extra depth for launch weeks or campaigns without really diluting long-term holders. That's an important aspect as well. And also, return for quote RFQ plugins. They basically add an optional API where professional desks can stream quotes over an AMM, automated market maker. So this way, users still settle on chain, but can enjoy tighter pricing. Yeah, I think in conclusion, Proud Liquidity, it can already handle the bulk of daily flow. It does on many platforms, layered with kind of platform-owned liquidity walls or kind of light touch RFQ desks. You can have a really good result, and that means sticky and transparent depth plus a kind of circuit breaker for black swan events, and this way you keep control inside the community, right? And Potato, will we have a closing speech, or if not,
Yes,
I'm okay.
we do. So,
Nice. Okay, that's
yeah.
my take on this one. Thanks. Back to you.
Yeah, thank you very much, Hassan. So with that, before we were to head on to the closing speech, now it's time to hear. Technically, it's time to hear from the community. So please do comment your community questions in, if I'm not mistaken, in this AMA, and the top five community questions will each win 20 AIoT tokens. So winners will be announced at the end of the AMA, so stick around, probably in the form of a tweet. So that brings us to the end of today's Talking Web3 special AMA. So what a deep, thought-provoking discussion it has been. So big thanks to our speaker, Austin from Alpha World, Mr. One from Dex One, Hassan from ACM Plus, and our KOL guest, Mini. So what are the key takeaways? Community-driven liquidity is no longer just an experiment. It's becoming the essential for trust and long-term value. So next one is tokenomic design equals to risk management. So aligning incentives beats patching up volatility later. And perhaps the most importantly, the future of liquidity is collaborative. So, with that, be sure to follow Talking Web 3 and Alpha World Web 3 and all of our guests on the stage. Until next time, so keep asking the right questions and let's keep defining what DeFi looks like. Goodbye.
Yeah, thank you everyone. Bye for now.
Thank you. Bye bye.
only just be